Exhilaration ignited the crypto world. The instant whispers emerged that Bitcoin was inching perilously close to smashing its own record of 111,917. Skeptics scoffed, but enthusiasts could almost visualize that towering number lighting up their screens. What in the world happened on that unassuming Saturday, and how does a seemingly modest climb of 0.2% hold the power to send the entire financial realm ablaze? Today, we are plunging headfirst into the fascinating puzzle of Bitcoin's relentless upward momentum, fueled by mounting interest in spot exchange-traded funds and the tantalizing possibility of a looming Federal Reserve rate cut. In this deep dive, we will uncover the intricate forces driving digital gold's price, examine the behind-the-scenes maneuvering of key investors, and find out whether Bitcoin might just dash past that all-time high in the not-too-distant future. First, let us rewind to the dramatic moment that captured traders' attention. On Friday, Bitcoin inched up by a slender 0.15%, hardly enough to jolt the average investor. Yet the very next day arrived with a surprisingly similar rise of 0.2%. To a casual observer, these figures might seem underwhelming. But for those who scrutinize the big picture, these back-to-back gains signaled something larger and far more electrifying. A renewed surge of confidence that could catapult Bitcoin beyond its previous peak of 111,917. With everyone's eyes locked on the next big move, we have to ask, why now? What secret catalysts are powering this quiet but definitive wave of optimism? One of the major talking points centers on easing geopolitical tensions that, for a time, had cast a shadow over global markets. Whenever high-stakes political conflicts settle or simmer down, the general appetite for risk often creeps up. Suddenly, traders look for new avenues, including digital assets, to lock in their capital. Meanwhile, we have an even bigger game changer on the horizon: speculation that the United States Federal Reserve might enact a rate cut in the third quarter of this year. That possibility alone has sparked a fresh array of calculations among institutional buyers, who seem eager to seize upon cheaper borrowing costs. The mere whisper of a rate cut is enough to alter the tone of the entire crypto market, conveying a sense that fresh funds may soon pour into higher-risk instruments, such as Bitcoin. But the story becomes even more thrilling once we delve deeper into official economic data. On Friday, the nation witnessed the release of the Personal Income and Outlays Report. While inflation saw a slight uptick, personal income and consumer spending posted an unexpected decline for May. Why does that matter? Because consumer spending shapes over 60% of the United States economy. When disposable incomes slip and families begin to tighten their belts, it can herald possible recessionary risks. With slower consumption, inflationary pressures often ease up, further reinforcing the notion that the Federal Reserve may indeed adopt a more accommodative stance sooner rather than later. Some might argue that this shift heralds an entirely new monetary era, one that bodes especially well for alternative store-of-value assets, including Bitcoin. Without robust consumer spending to worry about, the central bank could indeed step in to provide relief. According to the widely tracked CME Fed Watch tool, the probability of a Q3 rate cut leaped from 69.7% on June 20 to a staggering 91.4% just 7 days later on June 27. In the span of a single week, the conversation shifted from whether rate cuts might be in the pipeline to how quickly the Federal Reserve might act. That leap in probabilities was not random. It came on the heels of remarks from several prominent Fed officials, including Susan Collins, Mary Daly, Austin Goolsbee, and Michelle Bowman. Each speaker, in their own way, hinted that a pivot toward lower rates may be not only inevitable but prudent. In a financial atmosphere where the chance of cheaper money looms large, it is no wonder that speculators and institutional power players alike are rushing to accumulate Bitcoin. One of the most astonishing developments, however, took shape in the form of massive inflows into Bitcoin-focused spot exchange-traded funds, especially those based in the United States. Consider the data from Farside Investors, which laid out a jaw-dropping streak. By June 27, U.S., Bitcoin spot ETF products had witnessed 14 consecutive sessions of net inflows, reaching an eye-popping total weekly sum of $2,214.8 million. Over the entire month of June, net inflows tallied up to $4,476.6 million, building on May's solid $5,232.1 million. The question is not whether institutional players are taking digital assets seriously, it is how large these inflows might grow if the Federal Reserve truly enacts a rate cut. If you are as captivated by these staggering figures as I am, feel free to show some love with a quick like. Every little bit of enthusiasm helps us journey even deeper into the enthralling undercurrents of the crypto universe. Let us recall not so long ago when Bitcoin defied prevailing expectations by racing up to an all-time high of 111,917 in May. Back then, the driving force behind its ascent was likewise a combination of robust spot ETF inflows and an evolving macroeconomic backdrop. Now, though, the question remains: can Bitcoin recreate that dynamic with the same ferocity, or perhaps even surpass its former glory? Some analysts point to the ongoing shift in consumer sentiment, combined with investors' unwavering faith in Bitcoin's resilience, as a prime catalyst for renewed upward momentum. The macros might be aligning even more perfectly than they did before, but let us not forget that markets rarely rocket straight up without difficulty or anxiety. For every bullish sentiment expressed by a major Fed official or an ETF inflow tracker, there are voices warning that Bitcoin's climb could be stymied by any of 1,000 real-world disruptions. Political surprises, new regulatory measures, data security breaches, and abrupt changes in institutional allocation are just a few of the pitfalls that might arise. Although the big headlines are about surging confidence, one must not discount the possibility of short-term volatility, which has forever remained an integral aspect of Bitcoin's character. Still, the metrics remain undeniably encouraging. As we speak, Bitcoin is trading above its 50-day and 200-day exponential moving averages, painting a vibrant picture of bullishness. This crossing above major moving averages suggests that momentum is not simply a passing phenomenon, but is grounded in consistent trends over time. A deeper look into the relative strength index, which currently sits around 56.63, reveals that Bitcoin still has ample room before it becomes overbought. In other words, it might rally further without hitting that dreaded threshold, where analysts start to scream about unsustainable hype. From a narrative standpoint, it also pays to note how shifting consumer habits can result in ripples that bolster crypto demand. If the economy fumbles, whether via declining disposable income, waning retail sales, or simmering inflation, investors often seek out stable or at least alternative territories for their money. While the once heralded notion of cryptocurrency as a safe haven asset remains polarizing, growing interest from heavyweight institutions suggests that the conversation is evolving. After all, with each new swath of capital inflows, confidence in Bitcoin's longevity grows stronger. In line with that, keep an eye on how swiftly people pivot to spot ETF products. What was once a novelty is now considered a mainstream investment vehicle. Institutions wanting to offer clients exposure to Bitcoin through regulated ETFs have paved the way for colossal sums of money to flow in and out of the market. At the same time, this route spares everyday investors from the complexities of handling private keys, setting up specialized wallets, and worrying about the arcane mechanics of crypto exchanges. The user-friendly approach broadens the audience for Bitcoin, opening doors for participants who might otherwise have remained on the sidelines. Let us also talk about the Federal Reserve's motivations. For months, inflation has been the hot-button issue. Rate hikes were the chosen weapon to cool down the economy, discourage wanton spending, and keep price levels from spiraling out of control. But with inflation no longer accelerating uncontrollably, and with personal income and spending figures painting signs of a potential slowdown, Fed officials are apparently reevaluating their stance. That is why a rate cut in the third quarter is no longer an obscure fantasy, but a plausible scenario, as evidenced by the near 91.4% probability reflected in the FedWatch tool. If that cut does come to pass, it may release a surge of liquidity across markets, one that typically finds its way into risk-oriented assets like cryptocurrencies. Some might ask, does that mean a recession looms? After all, negative growth data from the first quarter, in which the economy shrank by 0.5% on a quarter-over-quarter basis, rings alarm bells. But ironically, even the mention of a recession often sends contrarian-minded traders flocking toward assets they believe can weather the storm, Bitcoin included. A slight downturn can amplify calls for monetary easing, and that, in turn, can intensify the hunt for yield and alternative investments. Unique as it may be, Bitcoin sometimes stands shoulder to shoulder with traditional commodities, precious metals, and real estate in the eyes of those searching for a hedge against financial turbulence. Still, the tale of digital assets would be incomplete without mentioning the second largest crypto asset by market capitalization, Ethereum. While Bitcoin surges on the wings of multi-billion-dollar inflows, Ethereum is lagging behind somewhat. Over the last few weeks, Ether has managed less than 300 million in fresh inflows into its funds. It remains above its 50-day exponential moving average but below its 200-day curve, giving off a mixed message regarding its overall trajectory. The relative strength index for Ethereum hovers around 47.42, signifying that further downside is possible. Some watchers speculate that Ethereum might slip back near its June low of 2,119 if macro forces or internal developments fail to inspire a more vigorous upswing. This gap in performance between Bitcoin and Ethereum is not merely a figure on a chart. It underscores how institutional attention can sometimes gravitate to one digital asset over another. Bitcoin's brand recognition, first-mover advantage, and portrayal as digital gold often granted a preferential status among risk-averse institutions cautiously stepping into the crypto domain. Ethereum, with its robust ecosystem of decentralized applications, carries an indisputable allure as well, but it may take specific catalysts, like big enterprise adoption or a groundbreaking upgrade, to ignite the kind of frenzied inflows Bitcoin currently enjoys. One cannot forget the storyline of Bitcoin's unstoppable demand. The impetus for new inflows arrives from varied segments of the investing world. Some highlight fresh interest from international financial conglomerates. Others point to the steady growth in smaller, regionally focused funds. Meanwhile, certain analysts track over-the-counter deals that show colossal blocks of Bitcoin quietly changing hands between private parties. The result? A mosaic that depicts a currency in high demand, underscored by robust fundamentals and a steady stream of positive macro signals. The enthralling aspect is how this all ties back to the crucial interplay between data releases and human psychology. Every fresh inflation figure, consumer spending snapshot, or central bank statement confines or liberates the investment strategies of countless institutions. With the Federal Reserve telegraphing a possible shift, the prevailing belief is that the baton of monetary support is about to be handed back to broader markets. Consequently, Bitcoin is perceived as a prime beneficiary, being one of the potential front lines for capturing surplus liquidity. At this juncture, let us pose a question. Could Bitcoin accelerate so intensely that it eclipses its May peak of 111,917 in the upcoming weeks? Or will the market remain stuck, inching forward sluggishly as it grapples with unresolved data and lingering uncertainties? A host of chart analysts maintain that nothing appears on the horizon to keep Bitcoin from testing that lofty level, especially in the face of ongoing inflows. Others caution that external shocks, a sudden geopolitical flare-up, or a radical shift in U.S. regulatory policies could easily derail momentum. For now, the hype continues, and watchers monitor every piece of news for the slightest clue. Should it test that coveted all-time high, we might witness a fast and furious rally, fueled in part by automated trading systems that jump on board whenever major price levels are threatened. That scenario can create a self-fulfilling prophecy. Price creeps up, algorithmic traders pour in, momentum grows, and before you know it, the number on your screen surpasses even the wildest predictions. This cyclical chain reaction is the hallmark of modern financial markets, and it is in plain view whenever a major asset class flirts with a new summit. Meanwhile, let us not overlook fundamentals such as Bitcoin's limited supply and the looming halving cycle, which stands to reduce the number of new Bitcoins mined each day. Historically, halving events have corresponded with bullish market phases, although correlation does not guarantee causation. Nonetheless, the coincidence of prospective rate cuts and rising institutional support with a halving cycle on the horizon could further electrify the bull narrative. It is precisely this combination, macroeconomic signals, institutional inflows, and intrinsic scarcity, that leaves even jaded investors wide-eyed with anticipation. Whether you are thrilled by the possibility or simply intrigued by the data, be sure to subscribe to stay one step ahead. You never know when the next significant spike or crash might unfold, and you will not want to miss our immediate breakdown when it does. Data watchers of all stripes keep an especially keen eye on net inflows. When the market saw over 2,214.8 million in a single week during late June, eyebrows shot up in the best possible way. That number built upon prior weeks of consistent momentum, culminating in a net inflow tally of 4,476.6 million for the month of June alone. For context, May recorded a remarkable 5,232.1 million in net inflows, a figure that at the time seemed nearly impossible to surpass. Clearly, though, the appetite is continuing to expand, and with talk of a Federal Reserve pivot hanging in the air, you can see the perfect storm forming over the horizon. There is also a distinct possibility that sustained price growth feeds a FOMO, fear of missing out, effect. We have seen this pattern before. New all-time highs generate headlines, which bring in fresh retail investors worrying that they will lose a chance at easy gains. Retail capital might be dwarfed by institutional flows, but it can still prove a significant force, especially when it floods in en masse and further amplifies a short-term rally. If hype continues, big price swings may follow, adding to Bitcoin's signature volatility. Of course, that volatility can be a double-edged sword. Rapid surges can just as quickly reverse if sentiment shifts. Some participants argue that we might see a wave of profit-taking should Bitcoin climb too high, too quickly. After all, the run from 107,340 to over 111,917 is no small feat, and some might opt to lock in gains. That said, significant support zones have recently appeared under Bitcoin's price, as indicated by robust buying whenever the market dips. This tug-of-war between profit-takers and accumulators ensures that the story remains suspenseful. The potential for a Fed-led liquidity surge is far from the only driver. We also have to consider the possibility of large corporate players seeking to diversify their treasuries with digital assets. Although the intensity of corporate adoption has waned since the craze that pervaded the market a couple of years ago, it remains a latent force that could resurface in an environment of falling interest rates. Additionally, global rating agencies and multinational banks, entities for which Bob, with his 28 years in the financial sector, has consulted, are increasingly open to the idea that Bitcoin might be a legitimate asset class, deserving of coverage in their portfolio models. Such an evolution in perspective can further solidify Bitcoin's standing among mainstream circles. Turning again to Ethereum, we cannot underscore enough that its position remains somewhat precarious right now. Yes, it does stand above its 50-day exponential moving average, but falling short of its 200-day average is a cautionary sign. Then there is the RSI reading of 47.42. While that suggests Ethereum is not in overbought territory, it also implies that a short-term drop could be on the cards if it fails to spark fresh investor interest. And we simply cannot ignore how the comparatively small inflows, less than 300 million in the last stretch, indicate a lukewarm institutional appetite relative to Bitcoin's meteoric numbers. All in all, the differences between the fortunes of Bitcoin and Ethereum reveal that even within crypto, you cannot simply lump all digital assets into one category of winners or losers. Specific catalysts and narratives can cause substantial divergences, meaning that if you are mapping out a crypto strategy, you should keep your eyes peeled for the next game changer that might lift one token over another. While Bitcoin's narrative currently revolves around unstoppable spot ETF inflows and nigh-certain Fed interest rate relief, Ethereum's big story has yet to fully materialize. That said, many longtime Ethereum believers maintain that once new updates or partnerships hit the headlines, the second-largest cryptocurrency will not be content to stand by and watch. Now, for those who remain on the fence, let us revisit the main question. Is Bitcoin's performance in late June and early July merely a taste of what is to come, or are we nearing a temporary ceiling that could give way to a correction? The case for further upside hinges on continued institutional demand, supportive macro data, and a Federal Reserve pivot that could free up liquidity for more adventurous allocations. On the other hand, the cautionary case highlights unpredictable factors like global tensions, abrupt policy changes, or even a simple wave of overzealous leverage building that, if unwound, might send prices into a tailspin. Ultimately, no single element decides Bitcoin's fate, and therein lies the allure that keeps watchers tuned in. Still, Do not underestimate the psychological effect if and when Bitcoin's value marches decisively beyond 111,917. Each time the market sets a new milestone, it echoes across social media, news outlets, and trading floors, creating that cycle of intense excitement that can drive further gains. But keep in mind, the higher an asset climbs, the more it can shake out those who believe its price has outpaced reality. The next few months will serve as a crucible in which Bitcoin either justifies its ever-growing hype or falters in the face of real-world complexities. From a technical viewpoint, the existing signals are fairly supportive. The coin trades above moving averages that typically act as key lines in the sand between bullish and bearish phases. Its RSI reading in the mid-50s suggests there is headroom for further gains without tripping the "this is too hot to handle" alarm that goes off above 70. So, from that angle, there is no immediate sign that Bitcoin is too overextended. Nevertheless, market watchers must keep a keen eye on shifts in volume, as major breakouts typically require strong participation. Whether you have been riding the wave of crypto since the early days, or you are just now testing the waters, the evolving tapestry of data, policy, and sentiment offers a riveting spectacle. Bitcoin, now entrenched in mainstream financial conversation, no longer stands on the periphery awaiting recognition. It is very much part of the establishment, even if it remains a disruptor at heart. And so, as a final thought, do you think we will soon witness an official policy pivot from the United States Federal Reserve that ignites another dramatic rally for Bitcoin? Or will economic challenges overshadow currently buoyant optimism, prompting the Fed to tread more carefully? Continue on this journey with us, stay plugged into every pivot, and never miss a beat in these thrilling developments.